Let me ask you something. You already know the federal government taxes your Social Security. We covered that in the last video. The IRS uses a formula called provisional income, and depending on your total income, they can tax up to 85 cents of every dollar you collect. Most people find that out the hard way. But there is a second tax, a completely separate tax, one that runs underneath the federal tax, quietly, on its own schedule, using its own rules, and takes another cut of the same check. Right now, 8 states in America are taxing your Social Security benefits on top of what the federal government already took, not instead of the federal tax. On top of it, and in most of those states, the rules are so specific, so buried in state tax codes, that most retirees living there have never once heard they apply. I talked to a retired electrician last year, 71 years old, had been living in Minnesota for 40 years, never planned on moving, never thought about his state tax situation because, as far as he knew, Social Security wasn't taxable at the state level. He found out it was when his tax preparer handed him a bill with $2,300 on it he wasn't expecting. That wasn't the worst part. The worst part was that he had been paying it for 3 years. Quietly, automatically, without anyone ever explaining why. Today, I'm going to name every state. I'm going to give you the exact rules for each one. I'm going to show you what it's actually costing retirees in real dollars. And I'm going to tell you the 3 moves that reduce or eliminate this tax, including one that most people in these states never think to make. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Kevin, and every week I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. Let's get into it. First, let me give you the full picture. 42 states and the District of Columbia do not tax Social Security benefits at all. 0. You collect your check, your state does not touch it. 8 states do. That number has been shrinking. As recently as 2023, it was 12. Missouri eliminated the tax in 2023. Kansas eliminated it in 2004. Nebraska phased it out completely by 2005. West Virginia just finished its phase out in 2006. The trend is moving in the right direction. States are competing for retirees, and they know that taxing Social Security is a reason people leave. But right now, today, 8 states are still doing it. And if you live in one of them, or if you are thinking about relocating in retirement, this information is worth thousands of dollars. The 8 states are Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. I'm going to go through each one in detail. But first, I need to explain something important about how this double taxation actually works, because it is more subtle than most people realize. When the federal government taxes your Social Security, it uses the provisional income formula we covered in the previous video. Your adjusted gross income plus tax-exempt interest plus half your Social Security benefit equals your provisional income. If that number exceeds $34,000 as a single filer or $44,000 as a married couple, up to 85% of your Social Security is added to your federal taxable income. Now, here is what state taxation does on top of that. In most of these 8 states, the state does not start from scratch. It starts from your federal taxable income or your federal adjusted gross income, and then applies its own rules, which means the income the federal government already decided to tax is the same income the state looks at when deciding whether to tax your Social Security. You paid into Social Security your entire working life. The federal government takes its cut. Then the state reaches into the same bucket and takes another. That is the double tax. And it is completely legal, and it has been happening to millions of retirees for decades. Let me show you what it costs in each of the 8 states. State 1, Colorado. Colorado has a 4.4% flat income tax rate. Here is the good news for Colorado retirees. If you are 65 or older, you can subtract the full amount of your federally taxable Social Security benefits from your Colorado return. That means most Colorado retirees 65 and over pay zero state tax on their Social Security. But here is the trap. If you are between 55 and 64, meaning you retired early, which many people do, you only get a partial exclusion. In 22.6, you can deduct all federally taxable Social Security income if your AGI is $75,000 or less as a single filer, or $95,000 or less as a couple. Above those thresholds, you get a $20,000 deduction only. For an early retiree in Colorado at 62, collecting $22,000 in Social Security with a moderate income, that partial exposure can cost $500 to $900 in state taxes annually. It's not catastrophic, but it's money nobody told them they would owe. State 2, Connecticut. Connecticut's rules are more generous than most people expect. If your federal AGI is below $75,000 as a single filer, or below $100,000 as a married couple filing jointly, your Social Security benefits are completely exempt from Connecticut state tax. Above those thresholds, 75% of your benefits are still exempt. Only 25% becomes taxable. Connecticut's income tax rate on that 25% ranges from 3% to 6.99%. So for a married couple in Connecticut with $110,000 in combined income collecting $30,000 in Social Security, 25% of $30,000 is $7,500 in potentially taxable benefits. At their likely rate of 5%, that is $375 in state tax on top of whatever the federal government already took. Not enormous, but real, and entirely avoidable with the right income management strategy. State 3, Minnesota. Minnesota is where retirees get hit the hardest. Minnesota's income tax rates run from 5.35% up to 9.85%. And Minnesota taxes Social Security on the same general framework as the federal government, with income thresholds above which benefits become taxable. For 22.6, if your AGI is below $84,490 as a single filer, or below $108,320 as a married couple, you can subtract all of your taxable Social Security benefits from your Minnesota return. Above those thresholds, the exemption phases out at 10% for every additional $4,000 of income. That phase-out is brutal. It means a married couple at $120,000 in income has lost most of their exemption and is paying Minnesota state tax, potentially at the 7.05% rate, on a significant portion of their Social Security. Meet Gary and Susan, both retired teachers, both 67, living in St. Paul. Combined income of $125,000, a pension, some IRA withdrawals, and $38,000 in combined Social Security. They are above the Minnesota threshold. Their phase-out means approximately $28,000 of their Social Security is taxable at the state level. At Minnesota's 7.05% rate, that is nearly $2,000 in state tax on Social Security alone, plus the federal tax on the same income. Gary spent 31 years teaching. Susan spent 28. They paid into Social Security at second jobs, summers, part-time work. Nobody sat them down and said, Minnesota is going to reach into your check every month on top of what Washington already took. That is what this video is for. State 4, Montana. Montana's rules mirror the federal structure closely. If your AGI is below $25,000 as a single filer or $32,000 as a couple, no state tax on Social Security. Between those amounts and $34,000 single or $44,000 joint, up to 50% is taxable. Above those upper thresholds, up to 85% is taxable. Montana's income tax rates go up to 5.9%. For a single retiree in Montana with $38,000 in income, 85% of their Social Security is taxable at the state level. Same exposure as the federal tier, at a rate approaching 5.9%. There is one partial relief. Taxpayers 65 and older can deduct an additional $5,660 from their taxable income. In Montana, that helps. It doesn't solve the problem. For a typical single Montana retiree collecting $20,000 in Social Security and sitting above the threshold, this can mean $600 to $900 in annual state tax on top of federal. State 5, New Mexico. New Mexico is more generous than its reputation suggests, but only if you know the rules. Single filers earning up to $100,000 per year will not have their Social Security taxed at the state level. Married couples with combined income up to $150,000 are also fully exempt. Those are relatively high thresholds. Most moderate income retirees in New Mexico are protected. But above those thresholds, Social Security benefits become part of ordinary taxable income. New Mexico's top rate is 5.9%. For higher income retirees in New Mexico, those with significant pension income, IRA withdrawals, or investment returns on top of Social Security, the state tax on benefits can still reach $1,000 to $2,000 annually. The trap in New Mexico is not the rate. It is the assumption. Most retirees who moved there heard it was tax-friendly and never looked at the thresholds. State 6, Rhode Island. Rhode Island offers an exemption, but only under two specific conditions that many retirees don't meet. To exempt your Social Security from Rhode Island state tax, you must have reached your full Social Security retirement age, and your AGI must fall below a specific threshold. For 2026, the Rhode Island exemption income threshold is approximately $95,000 for single filers and around $119,000 for married filers. Those numbers adjust annually. If you took early retirement, you have not reached full retirement age. The exemption does not apply. Your Social Security is taxable in Rhode Island regardless of your income. Rhode Island's top income tax rate is 5.99%. For an early retiree in Rhode Island at 63, collecting reduced Social Security, living on pension and IRA income, this can cost $800 to $1,500 per year in state taxes, on top of federal. And the cruel irony is that the people hit hardest in Rhode Island are often the ones who worked the most physically demanding jobs and retired early out of necessity, the people who most needed that money to stay whole. State 7, Utah. Utah has a 4.55% flat income tax rate and technically taxes Social Security, but it offers a retirement tax credit that offsets much of the burden. In 2026, Utah's Social Security tax credit allows you to subtract $95,000 worth of Social Security income from your return as a married couple filing jointly, or $75,000 as a single filer. For taxpayers who exceed those thresholds, the deduction is reduced to $20,000. The credit phases out at higher income levels. For many moderate income retirees, the credit eliminates the Utah state tax on Social Security entirely. But for higher income retirees, those with strong pension income, significant IRA withdrawals, or investment income on top of Social Security, the credit phases out and real Utah state tax kicks in. This catches people who did well financially and assumed their tax situation was fine. They cross a threshold they didn't know existed and suddenly owe Utah tax on income they thought was protected. State 8, Vermont. Vermont is the most aggressive state in this group for higher income retirees. Vermont income tax rates run from 3.35% all the way up to 8.75%. Vermont does offer an exemption if your AGI is $55,000 or less as a single filer, or $70,000 or less as a married couple. Your Social Security benefits are fully exempt. Partial exemptions apply at slightly higher levels, up to $64,999 single or $79,999 joint. Above those thresholds, Vermont follows the federal taxation rules and applies its own state tax rate on top. For a Vermont retiree with $90,000 in combined income at the 6.6% state rate, owing state tax on 85% of a $24,000 Social Security benefit means an additional $1,345 per year. stacked directly on top of the federal tax on the same money. Vermont is a beautiful state. Many people retire there specifically to be near family. They budget carefully, they plan, and then they find out their state is doing exactly what Washington did to their check and taking another piece. Let me show you what this actually adds up to over time. Take a married couple, call them Frank and Diane, both 68, retired, living in Minnesota, federal provisional income, $52,000. That puts 85% of their $36,000 combined Social Security, $30,600, into their federal taxable income. At their 12% federal bracket, they owe $3,672 in federal income tax on their Social Security. Then Minnesota looks at the same income and applies its own formula. They are above the Minnesota threshold. After the phase-out, roughly $26,000 of their Social Security is taxable at the state level. At Minnesota's 7.05% rate, that is $1,833 in Minnesota state tax. Total tax on their Social Security in 1 year, $3,672 federal plus $1,833 state equals $5,505. On $36,000 in Social Security income, that is a combined effective tax rate of over 15% on money they paid into their entire working lives. Over a 10-year retirement, assuming steady income, that is $55,000 in total tax on Social Security alone. Now put the same couple in Florida, or Texas, or Nevada. Federal tax, $3,672, exactly the same. State tax, 0. Same income. Same Social Security benefit, $18,330 less in lifetime state taxes, just from where they live. That is not a small number. That is a car. That is years of medical bills. That is the difference between leaving something to your children and leaving nothing. Now let me tell you what you can actually do about this. Move 1. Manage your income below your state's exemption threshold. Every one of the 8 states has an exemption threshold. In New Mexico, it is $100,000 for single filers. In Connecticut, it is $75,000 single or $100,000 married. In Vermont, it is $55,000 single or $70,000 married. Know your state's number. Calculate your projected income every December before the tax year closes. If you are sitting $3,000 above the threshold, delaying a $3,000 IRA withdrawal into January of the following year could keep you under the line and save you the state tax on your entire Social Security benefit for that year. This is not complicated. It requires one calculation and one decision made before December 31st. Most retirees never make it because they don't know the threshold exists. Move 2. Roth conversions to reduce future provisional income. Roth IRA withdrawals do not count toward your AGI. They do not count toward your provisional income. They do not trigger federal Social Security taxation. And in most of the 8 states, they do not count toward the state thresholds either. If you are currently in a low-income year, if you retired recently and have not yet claimed Social Security, or if you are in the gap years before required minimum distributions start, converting traditional IRA money to Roth now means smaller IRA withdrawals later. Smaller IRA withdrawals in retirement means lower AGI. Lower AGI means you may stay under your state's exemption threshold, which means your state does not tax your Social Security at all. The tax you pay on the Roth conversion today buys you protection from double taxation for potentially 20 years. Move 3. For higher income retirees, the relocation calculation. I am not telling you to move. That is a personal decision that involves family, community, healthcare access, and quality of life, none of which I can weigh for you. But I am telling you to run the number. Take your current annual state tax on Social Security, multiply it by 20 years, then compare that to the cost of relocating to a state with no Social Security tax, including the one-time moving costs and any property tax or cost of living differences. For Frank and Diane in Minnesota, That number is $36,660 in state tax over 20 years, just on Social Security. Many retirees who run this calculation are genuinely surprised by how quickly the savings offset the friction of moving. Some of them make the decision, many of them don't. But they make it with the full information instead of finding out at 78 that they have been paying a tax for a decade they didn't know existed. I want to spend a minute on the states that recently eliminated this tax, because the reason they did it tells you something important. Missouri eliminated its Social Security tax in 2000-2003. Kansas eliminated it in 2000-2004. Nebraska finished its phase-out in 2000-2005. West Virginia completed its phase-out in 2026. 4 states in 3 years. These are not wealthy, progressive states making grand social policy gestures. These are middle American states competing with Florida and Texas for the most valuable demographic in the country: retirees with fixed incomes, paid-off homes, and decades of spending ahead of them. Every state that eliminates this tax is sending the same message: retirees, come here, your Social Security is safe from us. The 8 states that still tax it have made a different calculation. They need the revenue more than they need the retirees. That is not a moral judgment, it is a financial reality, and it is worth knowing because it means the 8 states on this list are unlikely to change quickly. They are not competing for retirees the same way Missouri and Nebraska were. They have made a structural decision to keep this revenue, which means if you live in one of them, the double tax is not going away on its own. Here is your action list. 4 things. Do them before you close this video. 1. Identify your state. If you live in Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, or Vermont, you are in an affected state. Write that down. 2. Find your state's exemption threshold. I gave you the numbers for each state in this video. Write down the specific threshold for your filing status. That is your target number. 3. Calculate your current AGI without Social Security. Add up your pension, your IRA withdrawals, your investment income, your wages if you're still working. Where does that number sit relative to your state's threshold? If you are under it, your Social Security may already be fully exempt at the state level. Confirm that with your tax preparer. If you are over it by a small amount, you may be able to get under it with the strategies I just described. If you are significantly over it, you need to have a conversation with a tax professional about the Roth conversion timeline and whether the relocation calculation makes sense for your situation. 4. Ask your tax preparer this exact question. Are you applying my state's Social Security exemption correctly? What is the threshold and where does my income land relative to it? If they give you a blank stare, if they have never run this calculation for you, that is your answer about whether you have the right preparer. Let me bring it all together. 8 states currently tax Social Security benefits: Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. The trend is shrinking. 4 states eliminated the tax between 2003 and 2006. But the 8 that remain have made a deliberate choice to keep this revenue. It is not going away soon. The double tax works by stacking state taxation on top of the federal provisional income formula, 2 separate systems reaching into the same check. The real cost for a middle-income retiree in a high-rate state like Minnesota can exceed $1,800 per year in state tax on Social Security alone, on top of federal. Over 20 years, that is more than $36,000. The 3 strategies that reduce or eliminate it: income threshold management before December 31st each year, Roth conversions during your lower income years, and for higher income retirees, the relocation calculation done with full numbers, not assumptions. The retired electrician I told you about at the start of this video, the one who found out he had been paying $2,300 a year in Minnesota state tax on his Social Security for 3 years, he wasn't angry at the state. He was angry that nobody had told him. His financial advisor hadn't mentioned it. His tax preparer had filed the return correctly but never flagged it as something to plan around. His neighbors didn't know the rule existed. He just paid it silently. because the system doesn't explain itself. That is what this channel exists to change. If this video helped you, hit the like button right now. It takes 1 second and it helps this reach more retirees who need to hear it. If you are not subscribed yet, hit subscribe and turn on the bell. The next video I am working on covers the Medicare premium surcharge that can quietly add $4,800 to your annual costs, triggered by a financial decision you made 2 years earlier that seemed completely unrelated. You will not want to miss it. If you know someone retired or retiring soon in one of these 8 states, send them this video today. Not tomorrow, today. It is the kind of thing that is worth a text message. Drop a comment. Which state are you in? Did you know your state taxed Social Security? Tell me what you found out when you ran the numbers. I read every single one, and whatever comes up most becomes the next video. I'll see you in the next one.